And gentlemen, welcome to the second day of the conference on asset management of occupational pensions, organized by the Institute of Finance and Financial Regulation. I am George Kiadopoulos, Director of IFFR, and I would like to thank you and our speakers for joining us. So good afternoon to those of you who are in Europe, good morning to those of you who are in US and Canada, and good evening to those of you who are in Asia. As you can tell, we have a really international audience. So yesterday, we had a session on occupational pensions regarding their design and performance. We also talked about the regulation. The bottom line is that regulation is of utmost importance, and we also received important insights from one of the members of Pissarides Committee on pension reforms in Greece. Today, we're going to talk about strategies, and we're going to conclude the day with a roundtable discussion. All our speakers and panelists and moderators, chairs are distinguished professionals and academics. And without further delay, I'm starting with introducing Mrs. Violeta Spiropoulou, who is going to chair our next session. So Violeta is Assistant Manager in the Equities Division in Alpha Asset Management Mutual Fund Management Company. She has a number of distinctions, including distinction from Thomson Reuters as a successful portfolio manager in Greece. And Violeta is also the president of the CFA Greece. This is the Greek chapter of CFA. Violeta obviously is a CFA holder, and she holds a degree in mathematics from Patras University and a master's from York University. So Violeta, the screen is yours. Thank you.
Thank you, George. Thank you, Professor Kiadopoulos, for your kind introduction. Ladies and gentlemen, good afternoon and a very warm welcome. Second day of IFFR's conference on the topic of asset management for occupational pension funds, trends and challenges. It is my pleasure to chair today's very interesting session. I'm deeply honored to be joined by distinguished academic and professional speakers who will share with us their research findings and expertise on the strategies for the development of sustainable pension schemes, as well as some useful insights about responsible investing. In the order as they will be presenting, I would like to welcome Sébastien Betermier, Associate Professor of Finance, Desautels Faculty of Management, McGill University, Professor David Lake, Director, Pension Institute, City University of London, and last but definitely not least, Claudia, Managing Director, Global Responsible Investment and Governance, APG Asset Management. Before we begin, let me walk you through the agenda. Today's session will be split in two parts. In the part and main, that will last 40 minutes. We'll have our speakers' presentations. Each speaker will have 15 minutes time to present his or her views. In the second part, that will last 30 minutes, we will transition to the Q&A session. Please do not hesitate to submit your questions during the main part of the session. Let's kick off with our first speaker, where he will give us a quantitative description of the Canadian pension fund model. Sébastien Betermier is an Associate Professor of Finance at the Desautels Faculty of Management at McGill University, Canada. His work is in top finance journals and has received several distinctions, including a lead article in the Journal of Finance in 2017. In 2017, Professor Betermier founded the McGill International Portfolio Challenge, a global university competition that aims to find sustainable finance to complex social such as underfunded pensions and climate change. He was named one of the world's best 40 under 40 business school professors by Poets and Quants in 2017. Professor Betermier holds a PhD in finance from the Haas School of Business at the University of California at Berkeley. further ado, I would like now to hand over to Professor Bettelian.
Thank you so much, Violeta. And thank you, George and Violeta, for inviting me to participate in today's panel. Let me share my slides. Do you see my screen? What I would like to do today is talk about strategy insights from the Canadian pension fund model. When we think of the Canadian pension fund model, the key words that come back are competitive compensation paid to employees, direct investments, illiquid assets, independent governance, large scale, risk sharing between plan members and pensioners. Yesterday, Edward Van Gelderen from PSP gave an excellent presentation discussing the growth of PSP as a large and prominent Canadian pension fund and stressed the importance of good corporate governance to make this model work. What we do in the study that I'm going to present to you is take it one step further and provide a quantitative portrait of this model. This is a study that was published in the Journal of Portfolio Management earlier this year with a team of researchers from CEM Benchmarking. We aim to answer 4 questions. First, how successful has the Canadian model been over the past 2 decades? Second, which features of the Canadian model have contributed the most to its success? Third, is the Canadian model restricted to a few flagship funds, or is it widespread across the country? And fourth, can other institutional funds borrow features from this model? Which was a question that came back a lot in the Q&A yesterday. Now, to answer these questions, what we do is we use very high quality data from CEM Benchmarking, which is a global benchmarking firm based in Toronto. And we analyze performance metrics, asset allocation strategies, and cost structures for 250 pension fund, endowment, and sovereign wealth funds across 11 countries. So we can do a cross-country performance comparison analysis. Let me first tell you about our sample. We split funds into large funds and small funds. The cutoff is $10 billion USD. We look at 2 time periods mainly, 5 years from 2014 to 18 and 15 years from 2004 to 18. We also have a 20-year sample in the appendix with fewer funds. When we compare the properties of these funds, we find that the large Canadian funds tend to be larger than their peers. They're mostly public funds, and they're mostly asset managers. They don't tend to manage the pension liabilities directly as part of the fund structure. Interestingly, they also have a higher share of the liabilities that are indexed. And this is a point that I will come back to later in the talk. And they tend to have a higher duration of liabilities, so a more longer term structure on the liability front. We're going to analyze both the assets and the liabilities. Okay, so the assets, we'll split them 3 ways. We'll split them by asset class. So we'll have stocks, fixed income, real assets, which include infrastructure and real estate, hedge funds, private equity, private credit. We're also going to take the assets and split them along the lines of actively versus passively managed. And we'll split also the assets as internally managed versus externally managed. So multiple cuts of the data. For the liabilities, we do not have as much detailed information as on the assets, but we do know what is the duration of the liabilities and the proportion of liabilities that are indexed. So we'll replicate a liability portfolio that is a mix of nominal and real local bonds with the same duration and same proportion of indexation. We're also going to construct a portfolio that is long the assets and short the liabilities. So mimicking a pension fund that is long the assets, but managing and owing those liabilities, will create a long-short portfolio, assuming that the value of the liabilities is the same as the value of the assets. That is one assumption, because we do not have data on the level of funding of the plans. We're going to consider 6 performance metrics. 3 of them are based on the asset portfolio. So we'll look at a measure of risk-adjusted performance, the Sharpe ratio of the entire portfolio. For the volatility, we'll look at it based on traded indices so that we do not run into issues with private markets where the volatility might be deflated. We'll look at the geometric average return over the portfolio over the long term. And then we'll look at the traditional measure of value added relative to a policy portfolio. We're also going to have 3 metrics directly based on the asset to liability portfolio. So once again, the Sharpe ratio of the asset to liability portfolio, the geometric average return, and the correlation between assets and liabilities, which will give us a measure of hedging on the asset front. All the metrics are based on returns that are expressed in the fund's local currency, and all of them are net of cost. The first key result, when we compare all 6 performance metrics and we compare Canadian and non-Canadian funds, if we look at the large Canadian funds first, the first set of results is that the large Canadian funds are outperforming their peers on all dimensions. They have a higher portfolio efficiency, Sharpe ratio of about 0.93 over the past 5 years, as opposed to 0.59, a higher average return, and a higher value added of about 60 bips, as opposed to 20 bips for the average rest of the world fund. Also, interestingly, the large Canadian funds do a better job, a more efficient job at aligning the risk of their liability portfolio to their assets. So they have a higher Sharpe ratio on the long-short asset liability portfolio, a higher average return on that long-short portfolio, and also a higher correlation, about 0.48 as opposed to 0.28. And that's interesting because typically when we think about hedging, it usually comes as a drag in terms of the asset performance. But here we find that the Canadian funds are not only outperforming on the asset front, but they also have a higher correlation between assets and liabilities than their peers. The results hold when you look at 15 years, they hold when you're looking at 20 years. And they also hold, interestingly, when you're looking at the smaller funds, comparing small Canadian versus small non-Canadian funds, we also find that they tend to outperform their peers. When we go underneath the hood and understand the business model of these plans, we uncover 3 distinctive features. So here we're going to compare the asset allocation strategy and the cost structure of the Canadian and non-Canadian funds. The first finding, this is well known, it's not a surprise, is that the Canadians do more investments internally. So about 52% of their assets internally for the large funds versus 23% for the non-Canadian funds. If you're looking at the very large funds with more than 50 billion under asset management, you end up with 80% internal. The in-house management leads to the reduced costs. When you're looking at down here, you're looking at the cost structure within each asset class. It has been normalized to 100 bips for each asset class for the Canadian pension funds. You find that in most asset classes, fixed income, real assets, private equity, private credit, you find significant reduction in the total costs in the portfolios of the Canadian funds. And part of that is the move to in-house management. Now, what's interesting here is that the cost savings do not get transferred into the pensioners' pockets. No, they get redeployed inside the funds. They get redeployed in 2 ways. First, there's a redeployment of resources to investment teams within each asset class. So here, what's interesting is that when you're looking at the cost within the internal portfolio and within the external portfolio, you find that the Canadians outspend their peers in the internal about 18 bips to 7. They also outspend their peers inside the external portfolio 121 bips as opposed to 86. And the same pattern is visible within each asset class. So as the analogy, they do more of the cooking at home, and when they go out, they go to fancier places. We observe especially high spread in the resources when it comes to the risk management expenses and IT expenses. Here, the Canadians end up spending a lot more than their peers. The second form of redeployment is on the asset allocation. We find that the Canadian funds allocate more capital to strategic asset classes that not only increase portfolio efficiency, but also help to hedge against the liability risks. And this is what we find the win-win on the performance metric that I was discussing earlier. You find that the Canadians invest less in stocks, less in fixed income, more in private assets. But what's interesting here when you're looking at the data is that the real spread is on the real assets, about 18%, as opposed to 9% for the non-Canadian funds, twice as much in infrastructure and real estate. So this is more than a simple shift to private asset markets. There's a clear shift within the real assets, and within the real assets, we see fewer REITs and more on the infrastructure side. We find that small Canadian funds also have similar features. They do more in-house management, about 13% of their assets as opposed to 3%. They do more active investing, and they have a greater allocation again to real assets that are more expensive to join, but have those dual properties, both on the asset performance and on the liability hedging, 10% versus 7%. So what this is telling us is the Canadians, the small Canadian funds have adopted a light version of the Canadian model. In a way, the Canadian model, the way I look at it, is a dashboard where you can ramp up or ramp down levers depending on your scale. Now, to quantify the impact of these features on cost, we run a couple of counterfactual exercises. The first one is on the cost. So we take an average large non-Canadian fund, cost about 60 bips to run. We then impose the switch to in-house management, controlling everything else equal. That reduces cost by about 20 bips, 1/3. That's consequential. We take some of these resources, reallocate them toward each asset class following the data. That adds 5 bips in total to the cost structure. We revise the asset allocation to the private assets, and in particular the real assets. That adds another 5 bips, and that gives you about a 12 bips total cost for real assets as opposed to 10, but twice the allocation. In total, the Canadian model enables funds to do more while spending less. Another interesting counterfactual exercise is on performance. So here we start with a US public fund. We're looking at performance metrics on the asset side, asset liability, and asset correlation. We then change the liability profile of the funds to make it more Canadian, more indexed, longer term. We find that because of the greater indexed nature of these liabilities, the asset correlation goes up by a little bit from 15% to 21%. We then change the asset allocation to have more in the private asset classes and the real assets. You find that the Sharpe ratio goes up, and again, the asset liability correlation goes up from 21% to 30%. You then change the allocation inside the asset classes, again, in the same spirit. The Sharpe ratio continues to go up, the asset liability correlation goes up to 35%. We then do a little bit more work to adapt to the US market, which has a different profile as the Canadian one. And again, you can ramp up the asset liability correlation to 42%. And finally, we incorporate the cost differential, and that increases the Sharpe ratio to about 0.36 or 0.85 over 15 years. These effects add up. When you take all of them into account, you find that the 15-year asset Sharpe ratio on the assets increases from 70% to 85%. The 15-year asset liability Sharpe ratio increases from 11% to 29%. And at the same time, the asset to liability correlation increases from 15 to 42%. So we see gains everywhere that are consistent with the performance differential that I showed you earlier. So to summarize, we had 4 questions that we asked. First, how successful has the Canadian model been over the past 2 decades? Well, what we have found in this study is that the Canadian model funds have outperformed their peers, both in terms of risk-adjusted asset performance, asset liability management, and cost. Second, which features of this model have contributed the most to its success? What we have found is that the cost reduction that is associated with the switch to in-house management has opened the door to a broad range of additional resources. Greater resources spent on internal teams, increased allocation to strategic assets, and additional synergies resulting from fund-wide investments into risk management and IT infrastructure. The gains associated with this three-pillar business model, they go beyond the value creation. These are statistics that ultimately create performance at the whole portfolio level in terms of the overall asset to liability Sharpe ratio and increasing the asset to liability correlation. Third, is the Canadian model restricted to a few flagship funds? The answer is no. We find that consistent performance is visible across the large funds, but the model has also trickled down to a large number of smaller funds. And finally, can other institutional funds borrow features from this model? The answer is yes. We find that small funds have implemented a light version of the Canadian model. We've also observed important benefits associated with having index liabilities. It provides the ability to hedge against liability risk by investing in a diversified mix of growth assets. In other words, funds do not have to invest exclusively in low yield bonds in order to do the hedging. And so that has allowed those funds to do well, both on the hedging front and on the asset performance front. And so that's it on my end. Back to you, Violetta, and I'll be happy to answer any questions afterwards.
Thank you, Professor Betermier, for your insightful speech. You have described us all the attributes behind the success of the Canadian pension fund. Actually, you have shown us that Canadian funds outperform their peers and generating a higher Sharpe ratio. We are going now to move on to our next speaker, which is Professor David Blake. He will elaborate on a very interesting research paper about determining the number of default funds in a pension scheme. Professor David Blake is director of the Pensions Institute at City University of London and chairman of Square Mile Consultants, a training and research consultancy. In 2014, he was appointed chair of the Independent Review of Retirement Income. He won the 2016 Robert Mer Award for a two-factor model for stochastic mortality with parameter uncertainty theory and calibration, published in the December 2006 issue of the Journal of Risk and Insurance, the Journal of the American Risk and Insurance Association. The paper is the most cited paper of all time in the Journal of Risk and Insurance. He has a PhD from LSE. Professor Blake, the floor is yours. Unfortunately, Professor Blake, his camera is not working. So Professor Blake, please, you have shared your presentation.
Hey, Violetta, thank you very much. And thank you to George for inviting me. Can you hear me okay? I assume you can.
Perfectly.
Okay, thank you. So I've slightly different model from the previous speaker because I'm talking about defined contribution schemes rather than defined benefit schemes as Sebastian was talking about. And the title of the presentation is Smart Defaults. Can we determine the number of default funds in a pension scheme? The motivation behind this is that around the world, occupational defined contribution schemes typically require a default investment fund because some members fail to inform the scheme of the asset allocation that they prefer, their asset allocation preferences, and others do not feel well equipped to make the asset allocation decision themselves. So the law, certainly the law in the UK, requires a default fund. And you might think, well, by the term default fund, that means there should be a single default. But what we're going to try and show in this paper is it may be the case that if you ask the right questions and if you can identify different groups of people within your scheme, different membership within the scheme, then there may be a way of having a series of defaults, which we call smart defaults, that will improve the welfare of the members over having a single default. So the design of a suitable investment strategy will depend on members' risk and return preferences. And of course, the implication of that is the greater the heterogeneity of the members' preferences, the greater the number of default funds that will be needed. And we can think of two extreme cases, one fund for each member and one fund for all. And here is the simple capital market line, risk and return in risk, capital market line, efficiency frontier. And you can see here that if this is the default fund, asset allocation, then this is the optimal allocation for members classified as B-type members with indifference curves type B, but is not suitable for investors type C. It is actually too aggressive, it has too much risk for them, and is also not suitable for members type A. They would actually prefer to take on more risk. But if you're all required into this particular default fund, then there will be potential welfare benefits from trying to introduce smart defaults. So the idea is, can we design a suitable choice architecture? Smart default funds, smart default investment funds, construct the default asset allocation conditional on observable characteristics or preferences of the scheme members. Members can be guided using appropriate choice architecture, such as checklists, to determine whether they segment into mutually exclusive groups or have an interest in, say, ethical or Sharia compliant investing. So you can see that if you can segment and you ask questions and the members answer the questions, then it may be possible to design a set of default funds that improves the welfare for different groups of members. Of course, if a member doesn't answer any of the questions, refuses to engage with the scheme, doesn't respond to the risk attitude questionnaire that would be sent out when you join the scheme, then they will obviously have to be put into the global default fund that the scheme must have. I'm trying to. So the outline of the paper is that in this scheme, we're working with a group of people from my own scheme, which is USS, which is the University Superannuation Scheme, and my team at the Pensions Institute. This scheme, USS, introduced a DC segment in 2016 for members with salaries above 55,000. The USS scheme had been a typical public sector scheme in the UK, which had been a defined benefit scheme linked to final salary with inflation compensation, inflation uplifting, had been a typical scheme. But because of the deficit in the scheme, they had to reduce the risk by introducing a DC segment for members who were relatively highly paid, above £55,000 in 2016. So they were interested in assessing member characteristics and preferences. So we conducted a survey of investment preferences in November 2015, and we used a cluster analysis of the survey to identify how many different groups of people there are. And then we will draw some conclusions from that. So the empirical questions were, are there distinct groups of scheme members with similar sets of preferences? So can we identify a small number of clusters, and within those clusters, members have similar sets of preferences? The second question was how close these group preferences are to each other. Is it worth having a completely different set of asset allocation strategies if there isn't much of a difference between the risk attitudes of the group? And then we wanted to assess how close the risk attitudes of the USS scheme members were to those of the national population. And of course, if they were close to the national population, then you could design a default investment strategy that would be very similar to that for the national population. So we asked a series of questions. We designed a questionnaire that was designed to be answered in 15 minutes. We sent it out to all members. There were 12 questions on eliciting risk preferences, plus 2 additional questions. And they used one of our questionnaires. And one example would be, people who know me would describe me as a cautious person. And there were 12 such questions, and you answered on a 5-point Likert scale from strongly agree, neither agree nor disagree, and strongly disagree with the statement that is posed. And the 12 questions give an average ATRQ, an attitude to risk questionnaire. There were 6 questions on risk capacity. Risk capacity is as important as understanding risk preferences, because we need to know, have some some understanding whether members have the capacity to take risks. That would depend on whether they had young children, whether they had some disabled family member. And although they might have a strong attitude for risk, they might be willing to take the risk, they might not have the capacity to do so. So we had to assess risk capacity. There are 6 questions on ethical concerns. The ESG are those kind of concerns. 9 questions on participation intentions in the DC schemes, and 5 questions on the desirable properties of DC schemes. And all those questions were designed to be answered very quickly in no more than 15 minutes. So what was very interesting was that the clustering methods, there are 2 clustering methods. There's the Ward's hierarchical method and the K-means partition method. They're simply purely statistical methods of grouping members on the basis of responses. And what we found was that for the key groups, the 2 methods produced 2 distinct clusters for each age cohort, for all ages, and for the 45 to 65 cluster. So if we look at all ages, we had almost 10,000 responses, making it one of the largest surveys of risk attitudes in the UK. Normally, you might get 1,000 responses from a national population. But what we found was that both clustering methods produced for all ages 2 distinct clusters, and it also produced almost similar distinct clusters for the 45 to 65 age group. There were much more differences in the 25 to 44 age group. There weren't clear, distinct clusters in those groups. But that was regarded as less important, because it was only if you had salaries above 55,000 would you be eligible to take part in the DC segment. And there would be very few academics below age 45 who would have been would have been eligible to participate in the DC segment. So we were very comforted by the fact that for all ages, and for the 45 to 65 age group, we actually had 2 distinct clusters. And what the clusters, we can identify the 2 clusters. One group displayed higher pay, longer tenure, less interested in ethical investing, lower risk capacity, a higher percentage of males, and a higher percentage of academics. But what was unique, or what was incredibly interesting, was all members of this group had previously taken the active decision to make additional contributions. And you are invited every year, if you're a member of this scheme, if you want to make additional contributions, additional voluntary contributions to increase your pension. And many people just ignore the letter, but all this group, they had made the active decision of making additional contributions in the scheme to increase their pension. You can either do it in the form of what's called additional voluntary contribution, or you could buy added years in the defined benefit section. What we found also was that no member of the other cluster had previously engaged with the scheme in terms of making additional voluntary contributions. So we therefore were able to differentiate the two groups in terms of their degree of engagement with the scheme. So we regarded the fact that they had made inquiries about making additional contributions and then making additional contributions and experienced a reduction in their net take-home pay because money was being transferred into the pension plan. We classified that as the degree of engagement. So the first group was classified as engaged and the second group was classified as disengaged. So what were the results from the statistical analysis? The probability of engaging with the scheme is strongly positively correlated with age, pay, and tenure. And age, pay, and tenure are equivalent to the amount of pension wealth. The accrued pension entitlements you have will be very strongly correlated with age, pay, and tenure. Correlated with life expectancy, members who expect to live a long, healthy retirement are more likely to make additional contributions. And it's positively correlated with being an academic rather than being a member of the professional services staff who are also eligible to be members of the scheme. It's negatively correlated with the member's expected retirement age, implying that members with shorter time to retirement are more likely to make additional voluntary contributions to make good any pension shortfall. USS, what was interesting was that USS members are slightly less risk averse than the UK adult population. So they had an average attitude to risk score of 3.41. The range is between 1 and 5, compared with 3.56 for the national population. However, when we compare risk attitudes with the adult population in the UK with salaries above £30,000, which most USS members will have, salaries above £30,000, then USS members are marginally more risk averse, 3.41 compared with 3.34. For both the USS and UK samples, the attitude to risk scores tend to be weakly correlated with income and vary marginally with age. But USS members, the academics, are classified typically as public sector members. And it's known from studies of risk attitudes in the UK that public sector individuals are more risk averse than the national population. So the high percentage of USS members were labeled cautious. 16% of USS members compared with the 10% of the adult population over 30,000. Slightly fewer USS members are moderately adventurous or balanced. Male respondents in the survey tended to be less risk averse than female respondents. That's consistent with the UK national population when controlled for salary and age. The characteristics that other studies have found important determinants of risk attitude do not turn out to be significant for USS members. So age, gender, income, and pension wealth were not significant discriminators of risk attitudes. And we put this down to the high degree of homogeneity of these characteristics. The UK academics are an incredibly homogeneous group of individuals. And although there were two different groups that this cluster analysis found according to their degree of engagement, the risk attitudes of the two groups did not differ significantly at all. We have an interesting result that is typically found in studies is that there is a U-shaped pattern of risk aversion with age. Young individuals tend to be quite risk averse and old individuals tend to be quite risk averse. But in the middle group of middle-aged people tend to be much more risk tolerant than the age groups on either side. And we can see we have this slightly U-shaped pattern here, but a generally declining risk aversion to age, although we have the kind of U-shaped pattern here. Now, this was used by USS to justify what we call a lifestyle default fund, which will switch from equities to bond as the target retirement date approaches. So the default fund would have had a high weighting in equities and other return-seeking and risky assets when the member is young, and then it will mechanically switch to safer bond type assets. The member won't know anything about this, but it will switch to safer bond type assets in the 10 years before retirement.
So what was the Blake, excuse me, you have 1 or 2 minutes.
Yeah, okay, that's fine. All right, so I've only got a few more slides. US has introduced a single default lifestyle fund, which would de-risk gradually in the 10 years prior to retirement. It was designed to be optimal for the majority of scheme members who were B-type. It also introduced an ethical default lifestyle fund. There were 10 other non-lifestyle funds for self-selectors, including a Sharia-compliant fund to satisfy the preferences of A and C-type members. Again, these are the A and C-type members. What was the communication engagement strategy? This followed naturally on from the segmentation of the two groups into whether they had previously engaged, and about a quarter had engaged and 3/4 had not engaged. This involves informing all members at joining about the default lifestyle fund for those who are not interested in engaging with the scheme, and about the ethical fund. Self-selectors who will choose their own fund from 10, and that will not involve any de-risking, they need to be guided at certain ages, 30, 40, 50, and 60, into adjusting the risk exposure of the fund, that it will not happen automatically. USS should be particularly concerned about self-selectors who have never engaged with the scheme as younger members. When it comes to the appropriate time to begin de-risking, they're unlikely to be motivated to do so without suitable information and guidance. I think this is the final slide. Conclusions. We've identified a powerful method for understanding the characteristics of pension scheme members, for assessing how many clusters they fall into, for influencing the design of the smart default investment funds required of DC schemes, and for determining the optimal career length engagement strategy needed to ensure self-select members are guided at key ages into adjusting the risk exposure of their pension fund in order to maximize lifestyle and also maximize lifetime income. So that concludes my talk, and I hand back to you, Violetta.
Thank you, Professor Blake. It was very informative. You have pinpointed the results of the largest survey, which constitute a powerful method for identifying the characteristics of pension scheme members, as well as influencing the design of, as you said, the smart default investment funds. Now, I would like to turn to our third speaker, Ms. Claudia Cruz. She will navigate us through responsible investment. This is a theme, Claudia, with growing importance globally and in Greece as well, as asset management firms, PRI signatories have increased lately. We are 9 asset management firms in Greece which are PRI signatories, so we're curious to listen. Before that, Claudia, as Managing Director of Global Responsible Investment and Governance, Claudia Cruz is part of the management team of the investment function, reporting into the Chief Investment Officer on the board of APG Asset Management. APG manages pension assets of billion euros on behalf of huge pension funds. Claudia co-chairs the Principles of Responsible Investment Advisory Committee on the UN Sustainable Development Goals, and APG is also a member of the UN initiative Global Investors for Sustainable Development, which seeks to advance investment into SDGs. Claudia studied international management in Chinese and has a master in tourism and development from UCL London. I invite Claudia Cruz to make her presentation.
Thank you very much, Violetta. If you can please share the slides, then I can start introducing it.
Yes, please go ahead.
Good, wonderful. Yeah, so thank you very much for the opportunity to speak, to be here today. What I would like to do is give you an idea around responsible investing from a pension investor perspective. What are the considerations when designing and implementing a policy, and what are the components to think about? So we are a fiduciary manager, a dedicated fiduciary manager for Dutch pension funds. They are also our owners. That means that our own horizon is very much aligned with that of our clients. And that, I think, is the fundamental premise for responsible investing, to take that longer term view. Our clients have defined responsible investment policies, which we implement on their behalf. And the guiding principle is one which we call investing in the quadrant, or inclusion. So that means that every investment has to be considered in the context of risk, return, cost, and ESG, or sustainability. So that we have to structurally take this into account, and we don't just have a pocket that is sustainable, but actually the entire portfolio. So that is all asset classes, alternative and private markets and public markets. To all of them, the RI policy applies. We manage, our clients provide pensions to about 4.5 million Dutch people in a country that only has, I think, 16 to 17 million. So that is a very substantial part. And of course, the primary responsibility is to deliver affordable pensions so that they can retire into a sustainable world. When you then think about what is important with regard to responsible investing, it should be your policy should be very closely connected to the preferences.
Claudia, could you share your presentation? We can't see that actually.
Yeah, I'm afraid I can't share it on this computer because I'm in a Zoom connection.
Espinato, share it.
Otherwise, I just have to send it from one computer to another one while I keep talking. And so it is really this connection with beneficiaries that is so crucial, and that can be established through surveys, that can be established through very clearly hosting roundtables, not only with beneficiaries, but also with other stakeholders. And perhaps I just present without slides. I think that might be the easiest. I did send them earlier. And so in terms of the preference that have been expressed, so ABP and APG, we used to be one, and we already started in 1998 with voting our shares. And in 2007 had the first responsible investment policy that we published. And that policy upheld some very fundamental objectives that still hold, which is, one is contributing to risk-adjusted return. The other one is demonstrating societal responsibility. And the third one is also contributing to the integrity of financial markets. And that is really the aspect of engaging with policymakers, collaborating with other parties, either through bodies like the UNPRI or the IIDCC, the Institutional Investors Group on Climate Change, or other entities which allow investors, like-minded investors, to collaborate and to set standards for the market. So if you take those three objectives of risk return, integrity of the financial market, and social responsibility, then one needs to look at aspects such as stewardship, being active owners. And it means that for our entire equity portfolio, we do vote all our shares globally, and that is about 4,000 to 5,000 meetings a year. We also disclose our votes. We've done so for many years, that we're fully transparent about it. And also that we communicate very clearly to the market what are our corporate governance expectations. We have published a framework, we have published dedicated guidelines on remuneration, also specifically for the real estate sector. So in order that your investees also can be clear about what does this provider of capital expect of me. It is also the concept of being in an active dialogue with your investees. So having ongoing dialogue to remain in contact, to understand their perspectives, but also to engage for change. And this engagement for change is really clearly linked to the priority topics of our clients. And that is obviously climate, then it is human rights, but it is also biodiversity. And actually ABP has framed its policy against 3 transitions. One is the climate and energy transition, the other one is the natural resource transition, and the third one is the digital transition. Those are 3 key trends which affect how we invest and, of course, what the portfolio looks like. Beyond voting and engagement, ABP has made a very clear commitment to contribute to the UN Sustainable Development Goals. These were established in 2015, and they at the time said they want to double their exposure to what then used to be called high sustainability investments, and they have since announced that they want to have 20% of their assets under management in investments that contribute to the SDGs. In line with our ethos of being a long-term investor in collaboration, we have worked with the Canadian British Columbia Investments, with Australian Super, and also PGGM, the other Dutch fund, in order to establish the SDI Asset Owner Platform, whose goal is to set a market standard and really enable investors like us throughout their portfolio to identify and steer on investments that contribute to the SDGs. If you're interested in this, I would have otherwise shown you where you can find it, then please go to sdi-aop.org. Climate has been a priority topic for a long time, and we have expressed this, or we're tackling it through different dimensions. One of them has been a carbon reduction target for the equity portfolio, which we established first in 2015, and now looking for a further reduction of 40%. And it is also that we actively want to invest into solutions to help address climate change. So an investment target related to renewable energy has been defined. And we are also working on a portfolio-wide approach to address climate risk. This approach is scenario-based. It allows us to look at the speed of the transition. It allows us to look at both technology risk as well as transition risk as well as physical risk, and thereby identify our climate risk exposure. Of course, in the Netherlands, the Dutch Central Bank has been one of the early adopters of a very forward-looking approach to climate risk, so that also from the supervisory perspective, we're experiencing that there's much greater attention to sustainable investing and the topics and how they're integrated within the portfolio. What I should have perhaps said in the beginning, so my team, once the vacancies are filled, has 27 people based in Amsterdam, New York, and Hong Kong, which are our 3 core offices. And we're part of the investment function, and all our portfolio managers are likewise expected to help implement the responsible investment targets and really address it within their respective portfolios. So within real estate, we have set up an initiative called the Carbon Risk Real Estate Monitor, CRREM, and that allows us to identify to what extent real estate assets are Paris aligned. Are they below or above the path? That is a tremendous tool to have. It's of course entirely data-driven, but it really allows us to engage with our assets on, are you Paris aligned, and what we expect and where we want them to go. Last but not least, I'm aware of time. We considered important, we are asking transparency of the entities we invest in, and that we ourselves are transparent. So there is, on an annual basis, we produce a responsible investment report, and then there is further disclosures throughout the years towards stakeholders of all kinds so that they can understand how do we approach responsible investing and also encourage feedback from them. And I think I'll stop here for now. Thank you very much.
Thank you, Claudia Cruz, for sharing your thoughts. Very interesting initiatives indeed. And you have walked us through the EPG's strategies to incorporate sustainability in the investment process. Thank you all for your contribution. I think we would transition to the Q&A session for today's webinar. So I will try to, there are a lot of questions coming from our audience and I'm trying to address to you. I will start first for Professor Bertermier, a question for you. And actually it's 3 questions together for one of our audience. What has been the role of regulation on the success of the Canadian model, and how does regulator backtest the risk management models of the Canadian funds, and what is the process followed?
Thank you, Violetta. The regulation framework differs for each of the large pension funds. There's no common entity, but they are common patterns that you see. One of them is these funds are not regulated according to strict solvency metric, where the liabilities are marked to market and you need to maintain a minimum level of 100, 95, 110, whatever that threshold is. These funds are regulated mostly according to a going concern basis, where there is, and it depends on each fund, but there is a discount rate that is needed to match the liabilities over the long term that typically ranges from 4 to 6%. There is a tolerance for short-term deviations away from targets, which is what actually Edward was describing yesterday, as long as there's a common understanding about strong risk management processes being set in place and strong governance metrics. And so that is key because that allows the funds to think long term. And a lot of the business model that I've described is very much a long-term model that tolerates some level of risk in the short run, but that allows to access and harvest those risk premia while at the same time maintaining an asset portfolio that is aligned with the liabilities.
Okay, thank you. Another question, please, for Professor David Blake. Actually, there are 2 questions again. Together. Not every company can set up its own occupational pension. Small companies, for instance, cannot afford the costs for setting up such a scheme. What are the alternatives in UK and how successful these have been?
Okay, and, all right, go on.
Should I proceed with the second, please? Thank you. How does the regulator supervise the various pensions? Additional question. Thank you.
So just repeat the question on regulation, the second one.
How does the regulator supervise the various pensions?
Okay, so the first question is about the problem of small companies. This was recognized when the auto enrollment system in the UK was set up in 2012. So in 2012, all employees had to be auto-enrolled into their employer's scheme as the second pillar pension. All employees in the UK will have a first pillar basic state pension, but they will be auto-enrolled into their employer's scheme. Now, with because of small companies, the government set up a very large state-run scheme that would compete against the private sector called NEST. It's called the NEST. It stands for the National Employment Employers Savings Trust. So it is a very large scheme. It's now one of the largest pension schemes in the world, certainly in the UK. And very small companies actually decided that they would encourage their workers into the NEST scheme. Every employer has to select a provider, a pension scheme provider, and small companies have chosen NEST or one of the other large schemes. But this is for auto enrollment. So we do have the government did think about the problem of small schemes. So in terms of the regulatory supervision, that's obviously clearly an important question, because it seems that this conference has been had lots of issues about the regulator. So we in the UK, we have a pensions regulator that regulates trust-based schemes. We in the UK separate the legal situation in the UK is that pension schemes are set up under what is called a trust, under trust law, which is not common on the continent, but is common in Anglo-Saxon type countries. And there's a regulation of that. Now, insurance companies can also set up these schemes. And because they are companies, they will have an insurance regulator, a different type of regulator involved, because they happen to have a corporate structure. But the point is that the supervision really involves making sure that the assets aren't stolen, that the fit and proper people run the company, that the contributions are collected and invested in promptly. They're not really there to have any statement about the asset allocation or the de-risking. That is chosen by the individual managers of the scheme themselves. So the default investment fund it doesn't really come under much regulatory oversight, except for the fact that the regulator mandated that there had to be a single default fund for individuals that didn't make an active choice themselves.
Okay, thank you. One question for Claudia Cruz, please. What kind of ESG ratings do you use in your quant models, given that there is a divergence of ESG ratings across providers, as we all know?
Yeah, very good question. And indeed, it's that very point, because ratings differ quite a lot, that we don't use them. So we, of course, use research from different providers, and we treat it as data, as input to our own proprietary assessment. So for our entire capital markets portfolio, we run a process called inclusion, whereby all entities are assessed into either ESG leaders or ESG laggards. And that's based on a proprietary methodology, so our own assessment.
Okay, thank you. And one question from me, Claudia, as well. I would like to ask you, in terms of engagement policy that you mentioned, I would like to know what's the escalation process if there is an unsuccessful engagement with one company. What's the process you follow?
So we do many different types of engagements. We do corporate governance engagement, we do strategy engagement, or sustainability engagement. Under inclusion, which applies to the entire capital markets portfolio, we say if a company is an ESG laggard, you have to engage in order to be able to invest. And this engagement has to take place within a meaningful time. That is a few years, but not too many years. So after that, if there is no improvement, we would expect that the company no longer stays in the portfolio. But as such, it is, But of course, we fundamentally believe in using our influence to engage for change. And sometimes it is better to keep your seat at the table to really drive that long-term change.
And one question, I think whoever wants to address this one, in an era of low interest rates as today, combined with the demographic challenges, low birth rates, what is the future of defined benefit occupational pensions in Canada, Netherlands, and UK, and elsewhere? Wouldn't you say that eventually we will end up in defined contribution schemes? Who would like to start? Yes, Professor Bethenien.
I'd be happy to start on this one. It's an important question. What is fascinating in my mind about Canada is the country has expanded its DB type of plans, whereas most other countries around the world are transitioning toward more defined contribution types of systems. What's important here is when we're talking about the defined benefit plans that I was describing earlier today, we're not talking about the very classic DB plan where promises are made to pensioners. We're talking about hybrid plans where you have some risk sharing going on between pension plan members and pension sponsors, where the plans can take on risk, in fact, leverage their scale and expertise and a cost-efficient model to generate these returns while minimizing the risk, while trying at the same time to maintain fairly stable streams of pensions to the pensioners. And so in the end, this is not, in my view, a DB moving toward a DC. In my view, the best plans that will survive in the current environment of low rates and high longevity are plans that make combine the best elements of previous DBs and previous DCs. In many ways, the Canadian model has a business model along those lines. It is not the only one. There's other types of models, but it is thinking in terms of hybrid modes that we can think in optimal terms moving forward.
Okay, could I add to that?
Of course.
Thank you. So, I mean, the low interest rate environment, the democratic challenges, not only do they have they problems for private sector companies, they've got problems with the state pension system as well. The very generous state pension systems in the continent of Europe, for example, in my view, are unsustainable in countries like Italy with the demographic aging population. So it's a challenge. It's a challenge everywhere. But in terms of the private sector, the challenge is much more difficult because you need a solvent employer. And my own pension scheme, although universities are likely to be one of the few private, they're legally classified as private charities in the UK, although they have an infinite life, universities. There is a severe challenge for my own scheme, which is why they did this, as Sebastian said, move to a hybrid model. We in the UK in the private sector moved too suddenly from a defined benefit to a defined contribution model in a 10-year period in the private sector. Largely because the unions in the private sector weren't there, and so the unions weren't there to challenge this switchover. Also, workers did not value their pension. The point is the employer asked the human resource, the directors asked the human resource director, saying pensions are valuable, and the human resources director said yes. The finance director said, well, let's ask the employees, and the employees didn't really know that they had a pension in the company, and they didn't really value the pension. So that allowed the employers to move from, very good DB schemes to very poor DC schemes in terms of low contribution rates in a 10-year period. And now we're beginning to question that. And perhaps what we should have done was do what they did in the Netherlands, was kind of move from DB to a collective DC model without going, in which you risk share across generations. And there are some people in the UK wanting to see whether we can start to introduce collective DC schemes. But the reality remains that workers are starting not to work till 25 once they finish their education. They want to start to retire at the age of 55 and 60. They're going to live to 85 to 90. They're going to live longer. They're going to be retired longer than they were ever in work. They don't want to put anything into their pension scheme, more than 6% of their salary, and it just doesn't add up. It just doesn't add up. So unless we are prepared to work into our late 60s and to the mid 70s, which many people are fit and well to do if they're not in hardworking industries, then we have a really serious problem of sustaining the pension system in the developed world, either in the public sector or the private sector, or in the state sector.
Thank you. I think we are approaching to the end of this session. There are a lot of questions remaining, but we not have sufficient time. I think that I can see the speakers of the next session keep logging in. Professor Peter Mier, Professor Blake, and Ms. Claudia Cruz, I would like to sincerely thank you all for your contribution to our fruitful discussion. I would like also to thank our audience for their participation. Enjoy the rest of the conference and be safe.
Okay, bye-bye. Bye-bye.
Thank you very much, Violeta, and thanks all the speakers for this stimulating discussion. And actually, this discussion brings forward a very nice bridge to our next panel. So Professor Blake, for instance, talked about the risk sharing between generations and hybrid schemes. Actually, now in the panel, we're going to see some recent reforms, where actually are going in maybe in a different direction. But anyway, let me introduce the moderator for the panel. I have the pleasure to introduce Mr. Theodore Economou. Theodore is a very seasoned professional, and he has held a number of senior positions. He is a professional fellow at the Institute of Finance and Financial Regulation. He's serving as an advisor to various pension funds internationally, and he has a vast experience both in US and in Europe. Just to list a couple of them, Theodore has served as CIO at Lombard Odier Investment Managers. He's a member of the Investment Advisory Committee at the Virginia Retirement System. He has served as a secretary at the EU's Risk-Saver Task Force. He has served as a CEO and CIO at the CERN Pension Fund. Actually, he's a developer of the so-called CERN model. I guess Elena Manola is going to tell us more about this. But on top of his experience in the pension fund industry, Theodore has also a vast experience in the M&A sector, serving at the ITT Corporation. Theodore has also excellent academic credentials. He has graduated from EPFL at Lausanne, and he also holds an MBA from Northwestern, and he's a CFA shareholder. And last but not least, I should also say that Theodore has contributed enormously to this conference, being a co-organizer. So Theodore, it's really a delight collaborating with you, and thanks for contributing to the success of this conference. And may I also thank in advance our distinguished panelists. So Theodore, the screen is yours.
Thank you very much, George. A pleasure to collaborate on this conference. And let me say good afternoon to everybody, our panelists and the audience that is watching us. Thanks to our presenters, we've had 2 days of extraordinary insightful presentations. And we now come to the closing panel. And of course, this panel will address the overarching question of this conference, the one that, George, you have posed, the raison d'etre of this conference, which is what is the state of best practice globally in asset management for pension funds? And to answer this question, we're honored to have a unique privilege of being joined by 4 prominent industry leaders. We'll talk markets, we'll talk policy, we'll talk investments, we'll talk ESG, we'll talk globalization, deglobalization. So it promises to be an exciting 60 minutes. Joining us for this discussion, we'll start with Olivier Rousseau. Olivier is a co-chief executive officer of the French Fonds de Réserve pour les Retraites. This is a buffer pension fund that was set up by the French government 20 years ago for government pensions. And Olivier is in charge of investing its 26 billion in assets. He has 25 years of experience in investment management, spanning the globe, really from London to Tokyo, from Singapore to Sydney. He's a graduate of the École Nationale d'Administration, which is the elite French school from which nearly every French president in the last 50 years has come from. But as regards our industry, Olivier is a well-known innovator, both in factor investing, but also in ESG in the area of decarbonizing the portfolio and the work he did that with FRR. His stature is recognized internationally, I think we can say this. And a few years ago, he was invited by the government of Georgia, the Asian country, to chair the investment board of a newly created Pension Agency of Georgia. That's a compulsory national defined contribution scheme that was started from scratch in 2019 and that has already reached 650 million assets. So very similar to the situation in Greece. So Olivier is ideally positioned to tell us about the challenges of both managing a large pension fund established, but also starting one from scratch at a smaller scale. So Olivier, welcome. Next, I want to welcome Elena Manola Bonhund. Dr. Manola Bonhund is Chief Investment Officer for the pension fund of CERN. She joins us from Geneva, Switzerland. This is, of course, the intergovernmental physics research organization that counts 22 European countries as member states. She directs the investment of a 5 billion portfolio. And besides being one of the few women in Europe in a CIO position, she's gained prominence as an industry innovator as well. Among others, she has prioritized investments in the real economy with, as far as I know, the largest venture capital allocation of any private equity portfolio that I've ever seen. In fact, 100% of her private equity portfolio is in venture capital. So basically starting companies from scratch. She's also introduced investments in private debt, and she's financed the construction and development of hotels. Relative to the discussion we just had, 80% of assets are managed internally at CERN under Elena's direction. She's also had a distinguished career in physics. She's an expert in risk management for nuclear installations, and she's applied that to the management of the CERN pension fund. So welcome, Elena. Third panelist is Karen Shackleton. Karen is an independent advisor to 3 UK local government pension schemes, but her real passion is to bring a purpose to investments beyond just seeking returns. And to that effect, she founded an organization called Pensions for Purpose, and that aims to empower pension funds in taking decisions around sustainability, ESG, and positive impact. She has very ambitious goals, wants to 5% of the assets of UK pension funds within 10 years, to the end of the decade, to be invested for positive impact. She also has experience on the asset management side. She chairs an impact manager that invests in housing for the homeless and for women who've suffered domestic violence. And importantly, in the UK, she's vice chair of the Lord Chancellor's Strategic Investment Board for the Ministry of Justice in the UK. So welcome, Karen. And finally, we have with us Dr. Pavlina Karasiotou. Dr. Karasiotou is Secretary General for Social Security at the Ministry of Labor and Social Affairs in Greece. She's an economist by training. She has worked at the European Commission after receiving several graduate degrees in Belgium and the UK. She's held very senior positions, leadership positions at the Ministry of Finance for the past 16 years, culminating in her appointment 2 years ago as Secretary General for Social Security. And importantly and relevant to today's discussion, Dr. Karasiotou chairs the initial board of TECA, which is this new nationwide compulsory DC system that will start operations in Greece just 2 weeks from now, January 1, 2022. So the clock's ticking. And she's accepted the Herculean task of the monumental task of setting up the governance bodies, setting up the operations, the management, and all this in an environment of very, very high visibility. And of course, we'll conduct this panel in English, but I feel compelled to point out that Dr. Karasiotou, Pavlina, could conduct it with equal ease in Spanish, French, German, or Greek, so which is impressive. So with this, Let me start the panel by turning to Olivier. Olivier, you gave a presentation to an assembled group of institutional investors about 4 weeks ago in Switzerland. And you started your presentation by saying, and I quote here, "It's not an easy task being an investor today. It's not an easy task." Can you expand on that and share why you said this and what are the challenges?
Yes, thank you, Theodore. Sure. Well, I will start with the New York joke, the person asking for her way or his way and being offered as an answer, "If I were you, I would not start from here." But unfortunately, we have to start from where we are. And where we are is all markets are very expensive. It starts with sovereign yields, but it extends to all asset classes, all risky asset classes. And actually, the more the duration you have in your asset class, the more you feel the impact of the expensive sovereign asset class. And that is not an interesting or pleasant background to start investing, but we have to take it. If that's not enough, we have many revolutions underway, not easy to manage. One is the digital revolution. Is it changing dramatically the pattern of investing? I think we have people in both camps, the yes and the no, but it is an added difficulty to our intellectual framework. We have the climate issue and the advent of the ESG era for plenty of good reasons and for plenty of bad reasons as well, but it is very much there. We have an uneasy, inflamed geopolitical context. And finally, we have in front of us a policy mix paradigm reset, or at least a transition. That is not easy.
Olivier, I love the expression you used, the policy paradigm reset. That encapsulates the challenge. Elena, what do you think of that policy paradigm reset from your perspective? Does it scare you? What are the consequences?
I would agree with Olivier here. We indeed have a lot of challenges at the moment. And if you look at this, if you like, the exit of central banks, I like to call it exit, similar to what you see in private equity, for example, or venture. They have a very narrow window between, on one side, there is a threat of inflation or of a social unrest or growing disparities. And on the other side, the threat of policy mistake and meltdown of the market. So a very narrow window there, and it's really not clear how this is going to turn out. So this is a big question mark. I agree with you. And linked to this, and also amplified by pandemics, there is a question of the design of a global supply chain. Is global supply chain going to resist? Is it going to be redesigned, modified? And what is going to be the outcome in that way? And at the end, the ESG, that is yet another amplifier. And I would agree there also, there are two challenges related to the ESG, I would say. Two main risks. First risk of implementing ESG in a portfolio in a naive way. This is, I think, a great risk today. And the second, the climate risk, the real climate risk and the consequences of the climate risks on the growth, on the society, etc. So extremely difficult situation, challenging, not transparent in the moment. And I agree again, not obvious to engage in the investment activities from this starting point, if you like.
Well noted, Elena. Let me turn to Karen, because you finished on the ESG point. Karen can give us a perspective. Can you give us a perspective from the UK? We heard during the past 2 days a number of views on the implementation of ESG. We had a presentation from Claudia, that is from a very, very advanced European investor in that area. We heard from Elena about the risks that exist. Can you tell us what is the view from the UK on that topic?
Yes, of course. And good afternoon, good evening, everybody. So first of all, I think Eleanor made a really good point that ESG, if it's not implemented in an efficient way, can actually be detrimental. And certainly what I was seeing amongst some of the conversations I was having with pension funds a few years ago was that there was a little bit of a scattergun approach. So they were sort of targeting bits of their portfolio almost at random and trying to sort of tweak it so as to say they were ESG compliant. But I think in the UK, we're moving beyond that, and pension funds are starting to think a little bit more strategically about how they can embed ESG considerations into their portfolios. And certainly we work with pension funds by using the Sustainable Development Goals purely as a framework. I mean, recognizing that they're not all suitable for private capital investment, but just to get the discussion going in a helpful and productive way. And we ask pension funds to look at the Sustainable Development Goals with an investment lens, to think about the impact on their portfolios, either from a risk or return perspective. And what we have seen is that there are some real common themes that come through. So not surprisingly, climate action is a top priority. That pretty much every pension fund that we have worked with have said climate risk, it represents a threat to the value of our investments, and we need to take it into account in our portfolios. But what you then find is that there's some commonality around some of the economic related goals, because there's a recognition that you need economic growth in order to deliver returns on the pension funds. But then you see much more individuality. And so some funds will continue with the climate theme, others will start introducing social themes. And we've certainly noticed that health and well-being, for example, has come in the last 2 years as something that they recognise represents a threat to the portfolio and also an investment opportunity. And so we then sort of talk to, once they've identified what they want to prioritise, we then talk to them about how best to implement that along the spectrum of capital. So is it best done through responsible investment, through engagement, or is it best done through impact investment with intentionally trying to have a positive impact on society or the environment?
Very helpful. We're starting to get a picture of the universe of challenges that confront asset manager, institutional investors and asset allocators for pension funds. We have the massive policy experiment we're in the middle of with the impact it has on valuations. We have deglobalization going on at the same time with all the tensions it creates. Eleanor referred to supply chain. We have the climate issue. What do we do about it? How do we implement ESG? How do we do it in the best possible way? Now, Pavlina, let me turn to you. You hear all those challenges, and on top of this, you have an additional challenge, which is to start a whole new fund at a national level under the spotlight of really an entire country. How do you feel about this, and where do you stand?
Well, first of all, good afternoon, everyone. I'm very happy to be in this panel and having the chance to discuss and present what we're doing right now in Athens, in Greece. Actually, yes, very interesting discussion. I think it will be in our discussions in some months or some years, because right now the priorities for the Greek fund are, as you said, we are doing actually the setup. The Greek pension fund was, we voted the relevant law just 4 months ago in September, early September 2021. We've spent around 2 to 3 years designing, and we think we have incorporated in our law all the main lines of good governance, and pointing out the main lines for how to follow the investments and how to do the investment policy. But now we are really right now and for the past several months working entirely on the setup. This means doing the small things, bringing the first people to work in the fund, drafting the relevant texts on how this fund will work, exactly. And of course, the investments are to be discussed in the months to follow. Actually, we have we have 3 phases in the investment process. During the first phase, which is actually now till we have the first board. I have to mention that we are now the interim board. So from now till we have the first board, we are following a quite conservative policy as to the investments of the insured people, in order to not to bring any risk in the first pilot phase of the fund. And then we gradually, as the fund matures, we are introducing more risk. We are introducing, of course, the products will be life cycle, and we are also introducing some form of option for insured people as to the level of risk they are choosing. Of course, as the fund matures, all these considerations will come into place. And as I will have to say that in the law itself, we say that the fund is here for the purpose to serve the insured, but also to serve the Greek economy as well, whatever that means. And this will mature with time, and will have an actual form in the months or years, I would say, to come.
Well, thank you very much. You have quite a challenge for you. I want us to come back later and discuss the setting up of a fund and the ramp-up process, which I find an extraordinarily interesting challenge. But before we do that, now that we've set the landscape for the challenge of managing these multi-tens of billions portfolios, multi-billion portfolios, I'd like to move on to the, what can we do about it? And what we heard from our speakers over the past 2 days, we heard about a range of things that can be done, from the way assets are allocated, which asset classes, the balance. We heard about the importance of private assets and real assets in boosting performance against the challenges that we've seen. And we heard about the importance of properly implementing ESG. So I'd like to dig a little bit deeper in that with the first question to Olivier. If we look at this, massive policy experiment that you mentioned, and you think about the asset allocation decision, do I invest in stocks or bonds? Do I protect against inflation? What is a chief investment officer like you to do? Do you believe that you have to take a stance and try to predict the future and say, that's how I'm going to position my portfolio because that's what I believe will happen? Or otherwise, you just sit back and wait for things to happen? How do you approach that? Do you take a stance?
I think we have to. There are issues on which it's relatively possible to take a very clear position. There are others on which you may look at scenarios if you do not want to go for a main solution, a main scenario. But where you can probably take a very clear stance is the case of fixed interest rates, bonds. They are super expensive. If you do not have a obligation by law to have them, try not to. The real interest rates at which you are buying these things is terrible. And I liked the previous discussions, the previous presentations in which the superiority of having a liability set indexed to the growth of the economy in nominal terms is put forward. Clearly, the worst thing you can have is a nominal liability schedule. A real liability schedule is much smarter. It's much closer to the real life. And especially given that it is reasonable expectations that inflation will no longer be zero, but will probably be around its long-term levels and with a short to medium term overshoot makes the case for indexing your assets to the nominal evolutions of the economy even more potent. So off with fixed interest rate bonds, including investment grade. To me, investment grade is a lesser evil compared to sovereign bonds, but it's bad. Now, where you have to take a stance is equities. In my view, growth equities are very expensive because they have had a fabulous ride on the back of low interest rates going ever lower. And so people get more confident buying equities at very high price earning ratios because they compare to the very low current interest rates, even the long-term ones. And also when something has worked for some time, our nature is we think, oh, it's going to be the same forever. And the final point in that is, of course, when your taxi driver tells you to buy growth stocks, that gives you a reasonable point to sell. But even before that, you have to make your attitude in front of this very difficult issue. But I am saying it's not an easy one. Where on balance, I would say, I don't think we are in a totally different world where productivity and growth for those hyped stocks will be completely better than before. So back to the internet bubble in a way from the turn of the century. But even not taking a stance on that, you understand, I want to do that. But I have another point. I'm saying if you have growth stocks, you need to be aware that you have a massive duration position. So if you don't have long-term bonds, in a way, growth stocks can do part of the job. And if you do not have to have long-term bonds, then maybe you can take growth stocks and do hedgings on the interest rate curve by shorting the long-term rates. That's a possibility. On the positive side, I would overweight the cheaper markets in equities. That is the value style. I confess to believing that it will find a time when it will improve. In terms of geographies, that is Europe, not Switzerland. Switzerland is an expensive quality growth market, like Sweden, for example, but most of Europe is cheap. The UK is the quintessential cheap market, by the way, for good reasons, but also for bad reasons, I think. You have Japan and you have the emerging market. Lastly, I would put a focus on illiquids. Yes, it's very much in vogue, and that is in itself dangerous. But not all illiquid assets are as bad as the others. And yes, I like Elena's love for venture capital. I will explain why in one sec. I like mezzanine debt, and I like infrastructure, relatively speaking, okay? It's expensive too, but I like it relatively. And the nice thing with infra is that you can still do some impact and get a reward. Why do I like venture capital? Because I think, contrary to LBOs, where the valuation is very much a function of how cheap and available borrowing is, and now it's super cheap and super available, so it has to be expensive, and how expensive or cheap listed equities are, and they are very expensive today. So LBOs are very expensive. When you go just the other way, back at the bottom of the market in the life cycle, venture capital, the good thing in it is you are buying a project, you are buying an idea and a team that will implement it. The valuation in which you invest is not very relevant because your project will mature or will die in a few years' time, and you will sell it based on valuations in a few years' time. And I don't know what valuations will be in a few years' time, but I know that at least when I invest today, I do not stand to lose money if valuations collapse now. And now a geographical aspect, venture capital is very expensive in the US. But the good news is it is expensive in Europe, but just half as expensive as in the US. And we see plenty of American money coming to venture capital raisings in Europe. That's a good sign. And it creates a momentum, by the way. So plenty of very good reasons. Plus it helps the economy. Mezzanine debt, it's a sweet spot because contrary to
Olivier, let me cut you off right here because we have you shared with us a series of fantastic scoops here. Wow, it's really strong statements. Bonds out, growth equities, be careful. Overweight cheap markets. Underweight expensive markets like Switzerland. These are really, really extraordinary strong statements coming from the top of the 26 billion that you manage. I want to turn to Elena. Elena, does your risk management system allow you to take such strong stance and these really remarkable positioning that Olivier just shared with us?
I was listening very carefully and trying to identify something where I would disagree, and I didn't manage to find anything, Olivier, to disagree with what you said. So indeed, I completely share the view. I think over the last 10 years, we could, if we wanted to surf on the momentum and buy the dips and get the illusion that everything was perfect, that this is going to continue. But one has to be aware of this risk, the duration risk, not only in bond markets, but also in the growth, and to look at the risk cross portfolio. We are fortunate at CERN to have an excellent approach to the way that CERN Pension Fund is managed, and this is largely thanks to you, Theodore, that set up these models where we look at the risk actually as the main tool to manage the fund rather than asset allocation and other proxies to express risk. So yes, it allows us the flexibility to adapt the portfolio. I would not say that we would reduce or completely exclude all the bonds from our allocation, because there are also other considerations related to liquidity, etc. But definitely underweight bonds and shift the allocation from purely growth in equities to other sectors. Look for the venture capital for the same reasons that Olivier just described. And also with a large appetite for illiquid assets, not because of purely based on the fact that they are illiquid, but because we think that also we have developed competence and skill that allows us to exploit inefficiencies in the private market. I think this is very important.
Very clear. So a complexity premium, in effect, that you have set up your team to access. You are stating this is a really important factor that is driving you to private markets. The additional complexity, you're ready to take it on. You have the team. Intellectually, you're capable to do it, and it will benefit the members at the end of the day. Now, go ahead, Karen. I was about to turn to you, so go ahead.
So I was just going to give the UK experience. I mean, the local authority funds that I advise, one of the challenges that they're facing is that many of them are becoming cash flow negative. In other words, the contributions coming in are less than the pension payments going out. And that presents a real challenge for sort of the bond allocation, because that could have been used for paying the difference. And so what we have seen is a much greater interest in other secure income assets. Now, many of those are the less liquid assets that Elena was talking about, so private debt, infrastructure, for example. And we're also now seeing an increased interest in inflation-linked secure income asset classes, which is addressing the inflation risks, the headwinds that are coming our way with inflation as well. But I mean, the one point I would make is that, Olivier, I totally agreed with what you were saying about growth versus value. But for funds that I've advised where they've had a value manager, it can be really painful waiting for that strategy to come right. And it requires a level of commitment from the trustees that often can get a little bit uncertain. And of course, you really want to sort of hold them back from swapping out of it at exactly the wrong moment. But that is a challenge.
That's the big point. Absolutely.
Thank you, Karen. Let me turn to Pavlina. What we're hearing here a recurring theme, which is if we want to address the challenge of the current environment, that policy experiment. We've heard from our speakers in the last 2 days. We're hearing from practitioners here sitting atop of large governmental or intergovernmental pension funds that we need to invest more in private assets, including in the real economy. And importantly, this can only be successful, and Claudia Kruse also emphasized this, if we have an ESG approach, if we have a long-term horizon. Pavlina, do you think that the governance you're putting in place can allow for that? And let's make abstraction for a moment from the smaller size at the beginning. But does the governance allow over the long term for a fund that will reach several billion over the next 10 years? Do you think the governance will allow this kind of investments, this kind of approach, long-term horizon, illiquid private investments in startup companies, for instance?
Well, thank you. It's a very, very interesting, very nice question. Look, we are dealing here in Greece. We are dealing with a public entity. We have built a public entity, and we are dealing with mandatory pensions. People have to give 6% of their salary every month to the pension fund. This means that the fund, at least for the first years, will be under the constant, will be under the microscope of the public. And let me say, it is an uneducated public regarding to investments, which means that this poses more restrictions and risks. It may influence towards more conservative investment decisions. The next board, whereas textbook and also experience tells us that risks should be embraced in such schemes, especially when in the way we're building the scheme in Greece, the duration of investment will be 30 to 40 years, and the first pensions will be given after 40 years, since in the pension scheme, in the pension fund in Greece, we are allowing only newcomers in the labor market. So all these we have tried to describe in the law. We are building a strong governance, strong governance institutions, but we constantly have this balance that we should keep in mind. I mean, political risk, uneducated public, people that have never had their pensions, their mandatory pensions in a DC scheme, and could prove very sensitive in having even the slightest bit of a negative return. Even this doesn't really matter in the long term. So I think I would say to your question that yes, we have tried till now to describe the institutions that will allow in the long run to be involved in several types of investment. Also the ones you have mentioned, but I think this will take some time to evolve and mature.
And you said that on top of this, of course, you have that unfair advantage as an investor, the way of being able to place your assets at the at the Greek Central Bank, and getting a positive return, which I'm sure Elena is very jealous of, with her negative Swiss franc interest rates if she puts the money at the bank.
But this is just for some months in order to have the first board on place and give the responsibility to the board as it should be. We feel that no interim board should place such restrictions in the real board of a fund. In any case, also, we follow we have to follow the European rules on investments and restrictions and liberties that the framework on investments from pension funds give us. So this is more or less the framework we're working in.
Very clear, very clear. So in fact, you're telling us that you're setting up a framework that can, over time, while starting very, very conservatively,
yes,
will make at least possible to consider alternatives and will not block them off from the get-go.
We don't block anything off. We have all the framework there, but when this will come in place, it's something that the board and the time will show.
Let me turn to Olivier on this note. Olivier, you have the experience of actually guiding in its first 2 years, almost 3 years now, a newly set up governmental pension fund. I can't help but see the parallels between what you're doing, what you've led in Georgia with what is being described here by Pavlina. What would be your advice? What are the do's and don'ts?
Yes, a good question, of course. Well, first of all, my recommendations for a portfolio construction are in the real world. That's why I'm saying underweight, overweight. I'm not saying don't have at all and put everything in this segment of the market. I'm conscious of the limitations that we all face, especially when we are public institutions. And I can tell you, FRR's portfolio is not my dream portfolio because we have real life constraints. Georgia created a pension regime, indeed, a universal pension regime 3 years ago. And one of the issues they identified very much likens what you say, Pavlina, the political risk. Because in Georgia, there are very bad memories actually about pension money, because at the time of the breakup of the Soviet Union, the households lost their accumulated savings. So when the government spoke about putting in place a new pension scheme, they thought, well, okay, so we'll have the monies for some time, and when the state goes into difficulties, they will take it all from us. Okay. That's why they have tried to get the help from the World Bank, from the International Financial Corporation, from the IMF. It's part of the IMF program, by the way, in Georgia. And they decided that to reassure the people about the quality of the governance, they would put in place an investment board comprised of foreigners mostly, who would be, by definition, independent from the political power in Georgia. And they have 5 people, and most of them indeed are foreigners. And this investment board has enormous powers. It's not your typical advisory committee. We choose the chief investment officer. We decide the investment policy. We decide the strategic allocation. We choose the securities depository and many more things. So the political power decided to give confidence to the people that it would take the very strong help from representatives of respected Western institutions. So I represent a French institution. I have a colleague of mine who represents a Finnish institution. Another one is a former vice chairman of JP Morgan in London. So, you know, it's creating trust with all these things. But it remains. You have to accept that starting conditions are difficult. Be patient. It takes longer than you expect all the time, and do it well rather than just within the expected schedules and not properly. Set low expected returns in line with the reality. Invest progressively so that you even out the points in which you enter the markets, and still be very discriminant, i.e., not all asset classes are equally undesirable. So don't do too much on the undesirable asset classes, put more on the good ones. For example, and it varies country to country, in Greece, the nominal returns on bonds are not very nice. In Georgia, the treasury bonds, you get today 8% to 9%. Okay, there's more inflation, but still it's a nice real return that you can expect. Differs from one country to the other.
Sure. Thank you, Olivier. Some really wonderful points regarding your experience. I'd like to move now on to ESG with two questions really here. The first one is, can you implement ESG in a small fund? Are there impediments? Where do you start with implementing ESG in a fund? I'd like to ask first Elena to tell us how she started dealing with 22 different governments, each of them with their views. How did you, Elena, bring all this together to get started on an ESG journey? 22 different views, almost 22 different languages. I can't imagine the complexity of getting everybody together to agree how to embark on that. Can you tell us about this?
Yeah, absolutely. It's a very interesting question, and we spent quite some time trying to find the good formula. And the thing where we all agree, and there is no debate, that ESG is relevant, and that is an irrelevant factor to consider in our investment decision. And this is a sentence that any board member will agree. We maybe not agree what is exactly ethical or non-ethical, because this is very subjective, but we all agree that ESG considerations are very relevant for the fund and for us meeting our fiduciary duties. So this was the first and most important foundation of our policy. Then the next step was to make it clear and obvious that rushed and naive ESG implementation would not be productive. It would not help us meet any of the objectives, not help us meet the fiduciary duties, not necessarily help save the planet, would not be useful. So it took some time to explain this and to come with evidence, that is readily available, the evidence that, different providers of ESG scores don't necessarily agree on the one and the same thing, and, the data is not consistent. And if you base your action on the information that is not reliable, you can't really then commit to meet any objective that you want to achieve. The second element was to say that instead of rushing into very restrictive ESG policy, we first we be very serious about our engagements in our proxy voting and implement certain engagements policies and participate in collective actions. The third one was to look at the managers who are able to incorporate ESG considerations, not necessarily scorings, but ESG considerations in the way they select the investments. And it can be qualitative, it doesn't need to be quantitative. And the fourth one was to understand the different climate scenarios that our risk consultants can provide, and to understand what is the risk long term and how this risk can be addressed through the asset allocation, through the sectors, through geographies, and sectors. Flexible ESG strategy that takes into account the different challenges that we have today. Also, the one important challenge that I would like to mention is the stress between E and S, by contributing to the E, one still must not forget that there may be a negative feedback on S. So this is also something to reconcile.
Can you expand on this for our audience? What is exactly that stress between E and S?
I would say that rushed exclusions of certain sectors could create a social stress on the other side. So one has to look at this in a very comprehensive way. Exclusion of certain sectors without engagement can lead to unintended consequences in terms of prices and could penalize those who are at the bottom of the pyramid. We have seen a prelude of this, beginning of this autumn, when we were seeing energy prices going in a certain direction. So one needs to be, our feeling was that one needs to be extremely careful, data-driven, and the quality of data is more than important here. And without the solid and reliable taxonomy, there is only limited good that you can actually do through ESG.
So Elena, thank you for sharing what I find is a very, very clear roadmap. How do you get started on an ESG journey, step by step? And I'm sure this is helpful also to Pavlina. But I'd like to turn to Karen now, because you've described, Elena, how to get started. We heard from many of our panelists, where current best practice is in ESG area. But Karen, you have ambitions that go much beyond current best practice. You would like to move from ESG to impact. You would like 5% of assets of UK pension funds. So we are talking about hundreds of billions here, move into impact. Can you tell us what is this next frontier of impact investing that you are fighting for? How does it differentiate itself from ESG? How do practitioners, pension funds move in that direction?
So I think, I would say that ESG is a term that, to me, can embrace all types of investments. So if you're doing ESG integration into your investments, that is what I would describe as being a responsible investor. And what we're seeing is that investors are starting to then move further. Once they've thought about engagement, once they've thought about voting, then they're starting to say, well, is there more I could do? And some of them do go down the exclusion route. Others go down, if they're focusing on climate, they will think about the decarbonisation route. But very often they do get into some of these tricky conversations where, there'll be some of the committee who will want to do more, and there'll be some that want to step back and do less. The reason I particularly like impact is that it is a positive story. So this is where you're looking for investment opportunities that can both deliver market rate risk-adjusted returns and still have a positive impact and a measurable impact on either the environment or society. And
can I interrupt you? Can I ask you to be more specific? We have several questions from the audience on this issue of impact. How does it translate specifically into what kind of investments, what kind of asset classes? That seems to be a topic of great interest to the audience.
So they can, if you look at the Global Impact Investor Network survey, you will see that impact investments exist in every asset class. They exist in listed equities, they exist in private markets, in property, in debt, and it's a massively growing space at the moment. So it might be that you're investing in a property fund that is leasing residential housing to the disabled and helping them have a comfortable lifestyle with purpose-built accommodation, or care homes for the elderly, or homelessness, or violence against women, or whatever the particular social need is that you're trying to invest. Or you could be investing in a listed equity portfolio that is trying to target, have a positive impact on health and well-being, for example. And funds like that do actually exist. I've seen funds that are targeting education. There's just a complete blend of products out there. The important thing to look at is the fund manager intentional in their investment in terms of trying to have positive impact, and do they measure and report on that impact alongside measuring and reporting on the financials?
Very, very clear. So the future is impact. Because we need to wrap up slowly, I would like to take some points from the audience here. I'd love to discuss much more about impact, but we have some points that relate towards that. We have one question that is fairly sensitive that was also discussed yesterday about TECA investing in Greek bonds. And on the one hand, that investing in Greek bonds means the bonds will not count as the Greek public debt. This will certainly help the economy. Yet this borrowing, however, this may be suboptimal in terms of constructing TECA's portfolio strategy and will ultimately hurt the Greek pensioners. So Pavlina, what is your stance on this? And specifically, the audience asks this, how will you ensure that this will not be the case? So a loaded question.
Well, as I said, this is going to be the decisions of the board, the first board. We are only the interim board, and so we're not taking any decisions on that. The thing is that, as already said, the first interest of the pension fund of TECA is the best to serve the interests of the pensioners. So this will be the guideline in designing the portfolio. This is in the law, but this is also common sense.
Okay. So very clear reassurance from you that safeguards are in place.
I mean, on the other hand, yes, TECA has the ambition to become one of the investors in the country and be one of the factors that will boost country growth. Within, as I said, the limits and the restrictions of European law on investments and the legal framework also within Greece. So I think I've answered as much as I can on this question.
Absolutely, you have, and I think we all appreciate the delicate task you have in front of you. I'd like to jump on something you mentioned about investing in the Greek economy. I have a question here. You know, what does that mean? Does it mean tilting towards domestic assets? Does it mean investing in startups in Greece, or is it too early to tell?
It is too early to tell. It is too early to tell. This needs some maturity, and Olivier was absolutely right when he said that each country is different, each case is different. Also, the economic conditions that each fund starts are different, we need to take all this into consideration and be very cautious in the beginning, because we need to, most of all, we need to build credibility and need to build the image to the public, not frighten them, do specific cautious steps in order to build the good image. And our first concern is not to promise things that we cannot deliver, but rather be certain that we can deliver what we say. So it's better to say less and deliver than promise a lot of things and have everyone complaining at the end. So these are the guidelines we're following.
Very clear. And I have one more question here, which is also, I guess, a little bit provocative, which says, TECA guarantees, and I guess this builds up on the comment you just made, TECA guarantees pensioners' contributions. What this means for the audience, it means that in the law, there's a provision that at retirement, the pensioner will not get less than what she or he has contributed. However, in case of losses, note the audience, see, for instance, the 2008 financial crisis, the taxpayer will have to pay. Why does the Greek state take this risk, given that this is not an international practice? Now, before asking you to answer, I will point here that it is actually a practice outside Greece as well. The Swiss second pillar system, for instance, includes a similar guarantee, in fact, even stronger, because it guarantees a minimum return above the contributions annual, and the minimum return is set by the government annually. And Belgium also has pretty much exactly the same system. So with this, Greece is not really an outlier, but still the question remains, what was the logic behind this guarantee?
Let us keep in mind that we are talking here about first pillar pensions, and it's also mandatory. To this end, it was a decision, and it was something we measured. The cost is of this guarantee is not really too high, but it had to be taken, this guarantee, in order to reassure people that their mandatory pensions are going to be there, and no one will really will risk not to have anything at the end. The true risk guarantee to come in place, it's actually quite low. Because we're talking for a 40-year investment horizon, investment period. And actually, the guarantee doesn't come year to year. It's cumulative. We don't guarantee every year's contributions. It's on the whole horizon. So actually, the cost is not that much, but it's really necessary for people to feel safe and to know that they will not run the risk of having losses in their mandatory pensions.
Thank you very much. We need to wrap up, so we have one last question, which really is a repeat of a point that Elena already raised on the tension between ESG and performance. Does that tension exist? Does it reduce your investment universe? You talk about exclusions. And what are the principles to address that? Elena, you want to give us a couple? I think you're on mute.
There were some interruptions. I think now I'm unmuted. There were some interruptions. Yes, I think an EU ESG implementation would definitely, I think, open a risk open the risk of compromising the returns without a good reason, if you like. And this is all the difficulty. That's why we thought the prudent approach is absolutely needed. And if you discuss with the large asset owners, and we heard this in a previous session, is that they would develop their own ESG KPIs rather than use off-the-shelf ratings that they find. So, and this requires a lot of work. This requires a lot of resources. We are not yet there, but this is the direction we would be going towards.
Thank you, Elena. A very clear answer to a difficult question. With this, I'd like to close the panel, and perhaps just asking before thanking you formally, but can I ask you, each of you, you heard about Pavlina's challenge, Olivier, Elena, Karen. In one sentence, what would you have as advice, or from your perspective, managing large pools of assets around the world? Would you have one large sentence of advice to Pavlina in the task that she has undertaken? Olivier?
Take the time to present a framework which will be seen as robust by your peers in the EU, by the Commission, by the international financial institutions, and present it with those vettings to the people of Greece. That will be time very well spent. If it delays your effective start, that's not a problem, because the initial stage is crucially about building trust everywhere.
Thank you, Olivier. Karen?
I think I would say make sure that you have a very strong governance framework so that decision-making is clear. Start with a fairly straightforward investment strategy and building complexity as you develop. And just remember that the younger generations, of course, are far more passionate about ESG than perhaps some of the older generations. And so that is something that I would recommend that you include at the earlier stages of development.
Thank you, Karen. Elena?
Yes, I would say, I would agree with Karen. Strong governance is the key. Theodore, you know this too. And the first thing, then patience, and then invest in your internal team, in the internal company.
Yes.
Very clear. And perhaps one last word from Pavlina, your impressions and perspectives for TECA at this stage?
Yeah, actually, our main concern at this time is to find the right persons that will lead TECA to its first stage. The second concern is, as you said, build strong governance. The law is describing strong governance and solid, robust institutions, and this is actually something quite new for Greece. In the mandatory pension environment, I mean. On the other hand, we are concerned about building a robust image to the public, win the young people's impressions, and make them do care about their pensions, something that till now in a pay-as-you-go environment, no one really actually has a very strong awareness as to what pension is. People start thinking about pensions after the age of 50. So we need to bring this forward. I really agree with what Olivier and Elena and Karen have said, and I really appreciate that. I hope, well, it's a big challenge, but it's a nice challenge. It's something we are discussing in Greece for the past 20, 25 years, and it's only now that it's starting to become a reality.
Well, thank you for this positive closing message and inspiring closing message, Pavlina. I think we all wish you good luck on this road that you've taken. I want to thank Olivier, Elena, Karen, Pavlina, all of you for this exciting discussion, and turn back to George for the closing comments. Thank you very much.
Thank you.
Thank you.
Thank you very much, Theodore, and thank you all the panelists. Thank all the panelists. I think we had a really great discussion, which concluded a very fascinating conference. And I think this is a very fine example of what we mean at IFFR. IFFR is bridging the gap between cutting-edge academic research and the industry by addressing timely questions. And I think we saw today and yesterday a very fine example of our objectives. So to wrap up, we had 2 very exciting days. We talked about the asset management of occupational pensions. Yesterday, we talked about regulation and design and performance. Today, we delved more into performance. We talked about the Canadian model. We heard about what is going on in other countries, like in Netherlands, UK, in France. We talked about ESG. We saw how a case study about pension reforms, taking as an example Greece. We saw what are the challenges and what are actually also the opportunities. We had compiled the lineup of distinguished speakers, and echoing Pavlina's objectives about finding the right people. I think this group is really experts. So without further delay, let me thank all our speakers. Let me thank the audience, and let me thank our sponsors. Our sponsors contribute significantly to the success of our endeavor. And as I said yesterday, we view our sponsors as partners. We build long-term collaborations, we interact with them, and we move on. So I would like to thank once again our gold sponsors, Alpha Asset Management and PCS. FinTech has a very important role to play here in the asset management of occupational pensions. I would also like to thank our silver sponsors, Alpha Trust, Iolcus Investment, Piraeus Asset Management, and Systemic. I would also like to thank our media partners, Athena, Eurotoday, Finance Pro, Economiki, Business File, Nafteboriki, Next Deal, Savvy Investor, and C'est La Vie. And last but not least, I would like to thank the IFFR staff. I would like to thank Theodore Economou, who is a very fine example of what we mean by professional IFFR fellows. I would like to thank Despina Kontopoulou, who contributed immensely to this success. And once again, I would like to thank you all for attending this conference. IFFR is committed to contributing to this public debate. We have already held a number of conferences on asset management for occupational pensions and will continue doing so. We held a conference jointly with EBRD on ESG. We'll continue doing so. And you will hear more from us in the coming weeks. Once again, thank you all very much for attending, and have a nice evening or have a nice day depending on where you reside. Bye-bye.